You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. In the last 50 years, whenever yields at the short end of the Treasury curve have been higher than those at the long end, a recession has followed within 20 months. The reliability of this yield curve inversion, as it's often called, was first identified by Campbell Harvey in his 1986 PhD thesis, and has fueled anticipation for a recession this cycle ever since the curve inverted in the second half of 2022. With job growth slowing and the curve still inverted, some have argued that the Fed has been too slow to begin its policy easing. On today's episode, we talk with Dr. Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University, about the economic theory supporting the predictive power of the yield curve, whether this time is different, and what the implications are for Fed policy. Stay tuned. Coming up soon, our interview with Dr. Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University. But first, a quick market update. Last week's July CPI marked a string of 3 consecutive months of cooler inflation, firming rate cut expectations at the Fed's September 18th decision. The improvement was broad, similar to the previous 2 months, adding to the Fed's confidence that the worst price pressures are now in the past. Fed officials have signaled no hints that they would start this easing cycle with a 50 basis point rate cut, but that hasn't stopped the bond market from pricing in 50-50 odds of a big September cut for much of the last 3 weeks. July retail spending surprised to the upside, giving a reality check to investors who had seen recessionary red flags in the July unemployment rate 2 weeks earlier. The Atlanta Fed's GDP Now model is currently estimating 2% growth for the third quarter, not red hot, but also not so slow that the Fed will worry that its policy is overly restrictive. Preliminary revisions to payrolls data going back to April 2023 this week caused a relatively minor but notable bond market rally. Total employment as of March of this year was revised downward by more than 800,000, but spread over the relevant 12 months, average job growth is still not so low that the Fed is rushing to ease. Comments from Fed officials the last 2 weeks are consistent with expectations for lower rates next month, though there's a wide range of views on how rapid future easing will be. Chicago Fed President Austin Goolsbee has emphasized labor market weakness, while Fed Governor Michelle Bowman has expressed much more caution about easing while lingering inflation risks remain. Treasury yields moved generally downward the last 2 weeks, but not by all that much. Inflation data firmed 25 basis point rate cut expectations, but gave no fuel to those who are expecting a possible 50 basis point cut next month. The yield curve continues to be inverted after a momentary uninversion 3 weeks ago after volatility in foreign equity markets. That's all for the market update this time. Now our interview with Professor Campbell Harvey. Our guest today is Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University. Professor Harvey, thanks for coming on the podcast.
Thank you for inviting me.
Our discussion today will focus on whether we can apply the historical relationship between the inverted yield curve and recessions to today's economy. Now, Professor Harvey, your 1986 PhD thesis was the first to identify, as far as I know, the connection between the inverted yield curve and recessions. Before we get into how it might apply to today's economy, can you explain what the inverted yield curve is and the theoretical foundation of why it would signal an impending recession?
Sure. So let me just read the full text of my dissertation over the next 30 minutes. So it starts, no, joking. Look, the idea is super straightforward, I think. The fundamental idea is that asset prices reflect the expectations of the future. So think of a stock. The stock is the present value of the expected cash flows, or earnings. Think of it that way. And we know that earnings are impacted by the state of the economy. So the economy is doing well, earnings are higher. Within that asset price, you've got expectations of the future. It turns out that stock prices, however, are not that reliable because stock prices have two things. You've got the expected cash flows, but then you need to discount those cash flows to present value, and that discount rate is risky and it can move around. So stock prices tend to give a lot of false signals about future economic growth. So the idea of my dissertation was to move away from stock prices and move towards relatively risk-free bonds. And the economic theory is very straightforward, that we know that a bond yield has got three components. One component is the expected inflation, so the nominal component. Another component is the expected real rate. And there's a third component, a risk premium, that let's ignore that, given we'll talk about U.S. Treasury bonds. Basic economic theory suggests a direct link between the expected real rate and expected real growth in the economy. And that's kind of where I start. So I look at, in my dissertation, I pick two pieces of the yield curve, a longer term component, and I chose the 10-year Treasury bond because it's the most liquid bond out there. And then I needed something short term, and given that I'm interested in forecasting quarterly GDP, I chose the 3-month Treasury bill. Again, it's highly liquid. And the difference between those yields, the long term and the short term, is usually positive. So that's called a normal yield curve. However, in certain situations where the yield curve inverts, which means the short rate goes beyond the long rate, that's telling us something about growth expectations. It's telling us that people are hedging, they're nervous, they move more of their money into a longer term bond as insurance. And what does that do? Drive the price up, the yield down, and we get an inversion. So the theory behind my indicator is standard economic theory. I guess people just hadn't looked at it. The closest thing that I saw in my research, because you're always concerned that somebody else has had the idea before, and that eliminates your dissertation, right? So University of Chicago would never approve a redo of an old idea. The closest thing I found was a graph. It was only a graph, and it was in a paper by somebody called Reuben Kessel in 1965. And he just remarked that, oh, well, this yield curve, so the difference between long and short, tends to be cyclical. So he didn't relate it to economic growth. But when I was looking at it, it looked like a business cycle diagram. So I pursued a more detailed examination, linked it to theory, and then presented my idea at the University of Chicago. It was, at the time, in the 1980s, there were really only 4 recessions. And one person on my committee, actually maybe more than one, were skeptical because only 4 observations. But in the end, my committee decided that they would award me the PhD for actually 3 reasons. Number one, the idea, even though it was only 4 observations, it was well-founded in economic theory. So this was not a data mining expedition. The theory suggested this should work, and I provided a test of the theory. Number 2, the model got the double dip recession in the early 1980s. So this was like 2 pretty serious recessions back to back. And other models out there didn't get that. So this model was unique in that it called these 2 rapid fire recessions well in advance. And then the third thing that Merton Miller, the late Nobel laureate that was on my committee, particularly liked was that at the time, to get a forecast of GDP, you really had to pay for it. So there were companies that did this professionally with dozens of PhDs, great computing resources, data, complicated econometric models, hundreds of equations, and you'd pay them like $250,000 a year for a forecast. So my forecast using the yield curve was as good or better. And Mert liked this because he said, well, your forecast only costs 25 cents, which is at the time the cost of a Wall Street Journal.
Very cost-efficient recession predictor for sure. So at the time, if there were only 4 recessions that your kind of data set was looking at, we of course have had more since then. In those historical instances, what is typically the length of lead time? As we record right now, in early August, the curve has been inverted since July 2022, so just over 2 years. And as far as we can tell, we're not in a recession yet. So the curve goes inverted. How soon, typically, before we can expect a downturn?
So the yield curve, the way that I measure it, and that is the 10-year minus 3 month, inverted in November of 2022. So we're approximately at 20 months in terms of an inversion. The lead time is variable. So over the historic 8 recessions, the lead time has been as short as 6 months and as long as 23 months. So we would get to the historic maximum over the 8 in October. There are other leads that were 18, 19 months. So we're kind of in the ballpark. And some people say, well, the yield curve's been inverted for 20 months and no recession. Therefore, it's a false signal. And no, you can't say that yet. It might be a false signal, but you can't say that yet. And just the other day on my LinkedIn, I posted the similarity between 2007 and 2024. So I looked at the FOMC statement for August 2nd, 2007, where the Fed decided to hold the Fed funds rate at 5.25% in the face of a yield curve that had been inverted for 19 months. And the statement said, we're going to hold the rates high because we're still concerned about inflation. That statement could have been copied and pasted into the recent FOMC decision on July 31st, 2024. They held the rate at 5.25% in the face of an inverted yield curve for 19 months. Very, very similar. Other similarities were softness in the stock market, actually much more softness in 2007. So there are some similarities here, but the point is that the lead time is variable. And some people on social media criticize the model. They say, well, okay, it does give a lead, but it's not very reliable on the lead time. So it could be 6 months, it could be 23 months. And the way I look at it is you're asking a lot from a single variable. There's only so much that you can do like a single variable. And the most important thing is that it is giving a lead. So I guess the real question is, we're in the 9th inversion. The question is this a false signal?
I want to give an argument for the possibility that this time is different, and let me know what you think. So you brought up how we're only looking at a sample size of 8. This is sometimes, when I think about generalizing over presidential elections, for example, we only have one every 4 years. They're really not that frequent. And when it comes to business cycles, the economy each time is also very different. So the way that I see it, markets signaling expectations for a soft landing are actually consistent with an inverted yield curve this time. And the thinking behind that is inflation goes up as high as 9% in the year-over-year headline CPI. So the Fed has to raise interest rates into restrictive territory to fight that high inflation. And so the short end of the yield curve reflects those expectations, not only the expectations, but also that Fed funds are really high. If the market feels confident that the Fed is going to successfully bring inflation down, which with it means a normalized Fed policy, so no longer restrictive, but closer to kind of being neutral on financial conditions, that means the long end of the curve would be lower because Fed funds is lower and inflation is lower. I think that's the intuition for why it's consistent, and why we haven't seen an episode like that in the post-war period is that so many times the Fed has not really been fighting high inflation, they've been preempting it. And also when they've eased policy, it's because of a recession that wasn't necessarily a vanilla business cycle recession. 2020, obviously, because of the pandemic, 2008, because of the financial crisis, maybe 2000, 2001 was what you consider a kind of garden variety business cycle. But I just feel like the circumstances of this cycle are unique enough that an inverted yield curve would actually be consistent with market expectations for a soft landing. What do you think of that argument?
Yeah, so let's first define what a soft landing is. So I think we know what a hard landing is. And the recession 2007, 2009, the global financial crisis, that's a hard landing. What is a soft landing? A soft landing, the way that I define it, is either a mild recession or just slower growth. And in the mild recession category, I put 2001, and I also put 1990 and 91. These are mild recessions. Indeed, you get some quarters with negative growth, but year over year, real growth is positive. If you look at other information, and yes, I've got this simple model that the yield curve predicts future real GDP growth and recessions, but realistically, you need to look at other information too. And when you put all that information together, and you are correct, people say, well, maybe this time is different. Well, I would say every time is different. And yes, it's true, we only have 8 observations, and that is a plague that affects all macroeconomic research. So we have so few observations to work with. So yes, this time is different, and I believe that the inverted yield curve is pointing to slower economic growth, which might manifest itself in a recession, a mild recession, or just slower growth.
Yeah, a part of that normalization, a part of the many reasons why this cycle is different is that we were coming from such an overheated place where the unemployment rate got as low as 3.4%. We had massive fiscal stimulus, and so there was always going to be a slowdown. And so that is intuitive to me because we weren't going to sustain growth at, I think it was 3%, 3.5% in the latest revisions for all of 2023. And so if growth is slower this year, well, that would be consistent with an inverted yield curve. But I suppose the point you're trying to make is, will it be slower or will it be so slow that it goes into a contraction?
Yeah, so again, a soft landing could be slower growth. It doesn't have to be negative. Let me make a few other remarks. People also say, well, probably in September, the Fed's going to slash rates and the yield curve will uninvert. So next month, uninvert. Does that mean that you'll declare a false signal? And I said, well, no, look at the data. Look at the last 4 recessions. The yield curve uninverts before the recession actually starts. So this is just a property of a leading indicator. You get the signal, and then it normalizes, and then the episode manifests itself. So I do think that that's important. As for the overheating, it is true that unemployment went down very substantially, but economic growth has been okay, but not really robust. So growth in 2023 was actually 2.1%. That's okay, and if you're in Europe, that's really good print, or Japan, but in the US, 2.1% just isn't good enough, especially given that the deficits over the last 4 fiscal years have totaled $9 trillion. The most recent fiscal year, 1.7 trillion. But getting back to this time is different and looking at other information, and I did mention 2007, so the peak of the business cycle was December 2007, and then we went into the Great Recession. There are things that are different. So in 2007, our banks were acting like hedge funds with extreme leverage, 40-to-1 leverage, essentially financed by deposits that were FDIC insured, which didn't seem fair. And then aggressive tactics for offering not just low interest mortgages, but allowing people to borrow up to 100% of the value of the house that they're going to acquire. that meant that consumers had very little equity in housing. And today, they've got a large amount of equity. So the amount of debt compared to value is about 41% right now. There are 32 million mortgage holders today that could go to the bank and get another $100,000 if they needed it, given the amount of equity in housing. So housing is not going to cause a problem. The big banks are not going to cause a problem like they did in 2007. So that's all positive information in terms of this being a softer landing. The other factor that's really important, and you know that there's another indicator called the SOM rule, and that was recently triggered. And this has to do with the acceleration in unemployment. So let me give you my take on that. And to be clear, employment is a so-called coincident indicator. It's not a leading indicator of the business cycle. And the SOM rule is very useful in identifying whether you're in a recession or not. The idea is that recessions are dated by the National Bureau of Economic Research, but they don't date them in real time. So they might date the beginning of a recession a year after it actually begun. But the SOM rule is very useful in actually determining whether in real time you're in a recession. However, and you make this point, this time is different. If I was looking at employment, I would look beyond acceleration because other information needs to be taken into account. One obvious piece of information is where you start from. So if we start from, let's say, 1% unemployment and we go up to 3%, well, that's no big deal. Like 3% is good. And we're kind of in a similar situation like that, where the rate of unemployment today is historically would be viewed as a good rate of unemployment. Number two, you need to look at the ratio of job openings to unemployed. That, over the last year and a half, has trailed down from 2-to-1 to 1-to-1. But 1-to-1 is very good. And what that means is that if there is an economic slowdown, people start to get laid off, that the duration of the unemployment is fairly low. And yes, obviously openings would decrease, but still you're starting from a pretty good number, 1-to-1. And that's different. So if you look historically, that is a good place to be going into a recession, and it's consistent with a slowdown that we can characterize as this soft landing. You think about what happens. When people become unemployed, they drastically change their spending. And consumer spending is 70% of GDP. So it is a very important component. And then there's a last thing, and this kind of ties back to the yield curve. So some people say, well, when an indicator becomes popular, as my indicator did after the global financial crisis, people realize, oh, this is 7 out of 7. And it was screaming recession before the global financial crisis began. So they start taking it seriously. And if you think about it, since November of 22, it's been inverted, and it's changed behavior in terms of corporations. So when you've got an indicator that's 7 out of 7 or 8 out of 8, and you're thinking of, let's say, a new capital investment, bet the firm, a lot of debt, you think twice. And so, well, maybe we should wait. Maybe we should see how this plays out. Or you might do something like we saw in 2023, some healthy firms doing layoffs. So we're going to lay off 5% or 10% of the workforce. And why are they doing that? Well, they want to strengthen their balance sheet because the yield curve's inverted. And that increases the chance that if we do go into a recession, that a company doesn't need to take drastic actions and the company will survive. So this changes the impact of the yield curve. So the yield curve becomes what I call causal. So everything I've said points to an inverted yield curve actually slowing investment spending, curtailing some employment, and that actually slows economic growth. The idea is that the yield curve is acting as a risk management tool now. People using it as a tool. They put corporations in a stronger position. Yes, that slows economic growth, but it also reduces the probability of a hard landing. It reduces the probability that a company, instead of doing like a prophylactic 10% layoff before a recession starts, that they're forced in short order to do like a slashing of the labor force, 40, 50%. And that's really painful, super disruptive for the economy. So I think that there's enough going on outside of the inverted yield curve to be optimistic that we can get through this with either a minor recession or slower growth. The major risk factor, unfortunately, is the Fed. And my LinkedIn over the last few years, you can see that I've been very critical of this. The Fed overshot. So they took the Fed funds rate far higher than was necessary, and they've been very stubborn in keeping it at an elevated rate. And it is reminiscent of 2007, where they made the same mistake. Higher rates degrade economic growth. Think of mortgage rates going up. It's a disincentive to buy a house, or for a corporation looking at an attractive investment project, the cost of capital is so high that they don't pull the trigger. So both of those degrade economic growth, and we need that economic growth. And the reason that we need that economic growth is that we are faced with a structural deficit situation and high debt in the U.S. economy. That problem is not going to be solved by increasing taxes, because that is a toxic platform for any politician. It is not going to be solved by cranking the printing press to essentially inflate the debt away, because we know that will cause inflation, and indeed inflation is like a tax. But it can be solved with higher growth. So 2.1% to me is completely unsatisfactory. In the post-war history, we've had 5% of real growth. Other countries can do 5% of real growth. Why can't we do that? It is definitely possible, and that's what we should focus on. We need to focus on growth. We'll get through this episode with slower growth, and we need to get our balance sheet in order and implement policies that focus on innovation and growth.
I want to revisit that historical tendency of kind of the varied lead time that the inverted yield curve has for a recession. So by your calculation, the 3-month bill and the 10-year treasury, the inversion started in November of 2022. So looking back at that, what would you have done differently for Fed policy? You know, if we're in this position where the curve inverts, and so, okay, there's a good chance that a recession might be anywhere from 3 months to 20 months away, but inflation is still high. That's the two sides of the Fed's dual mandate conflicting with each other. And so maybe it's easy to say in hindsight, well, this was flashing red, a recession was on its way, but the Fed also need to worry about price stability. So what would you have done differently over the last 2 years to make sure that the Fed kind of created a normal, healthy economic landscape that was able to have price stability, but also not have the slower growth that you're talking about?
So it's not 2 years, it's 3 years. And let me talk about 2021. So this is before the yield curve inverted. So you asked me what I would do. In 2021, it was obvious that inflation was going to surge. And the key is that inflation is highly predictable because the largest component to inflation, shelter, operates with a lag. So the lag is like a year to a year and a half. So shelter's 36% of the CPI. And in 2021, if you're looking at what's happening with shelter, it is spiking. So we are seeing year over year rents that are in the double digits. Yet the number that is going into the CPI calculation is like 2 or maybe 3% year over year. So it's completely different than observing real-time, let's say, rents. I'm saying this is a surge, and it's a serious one. The Fed is saying it's transitory, and they did nothing. So they kept the rates zero for an extended period of time. Again, this is a time where we're having economic growth. This is a time with low unemployment. This is a time with record high stock prices, yet the rate is zero. And then what happens? They decide to retire the word transitory, and then they start a very aggressive rate hike. In short order, the rate is pushed to 5.25% from 0.25%. Okay, so that's when the yield curve actually inverts. So to me, if the Fed was actually on the inflation problem earlier, then we might not have had a yield curve inversion. And then the other mistake is playing out in real time. The same story on inflation. So if you look at, let's say, Zillow or apartmentlist.com, look at year over year rents, like apartmentlist.com is like minus 0.8% year over year. So it's effectively zero. But then you look at the latest inflation print and you see the number for shelter, it's 5.2%. So that's a spread of 6%. Again, the Fed is looking at that number, the CPI, it is stale and is making policy based upon stale data. If you substituted the 5.2% with a realistic real-time measure of shelter inflation, then the CPI is not 3% year over year, it's 1.5% year over year. And it has been like that for about a year. And again, having that rate high is something that degrades economic growth. To a large extent, the slowdown and recession is a self-inflicted wound.
I want to push back on that just briefly. I mean, I think you do make a really good point that when the Fed is in this data-dependent mode, they're necessarily reactive. So they're setting themselves up to be behind the curve and really not being able to get ahead of an inflation fight or staving off a recession. But to the Fed's credit, they did exclude shelter from their preferred gauge of underlying inflation, the supercore, and they excluded goods from that too, because even though those are not reported with the same type of lag that you talked about, there was still some, it's a dirty word now, transitory, but there was some normalization of supply chains there that were causing deflation or disinflation in goods prices that was not going to last forever. So I think the Fed is aware of the lags that happen from that methodology, but that's why they were looking at the supercore. And as far as I know, the supercore year-over-year terms did decline substantially by the end of 2023, but it was not at the Fed's 2% target.
Yeah, so we can speculate as to what the Fed actually knows and doesn't know. And we know that we can slice and dice the CPI in many different ways. My point is pretty simple, and that is we've got a CPI, and actually I prefer just looking at the overall CPI. I actually don't care. We could use the personal consumption expenditure deflator, which the Fed likes better. That doesn't matter. So we can't exclude anything, in my opinion. And you certainly shouldn't exclude shelter. I'm not saying to exclude shelter. I'm saying to use a measure of shelter that reflects what's happening today, not last year. So multiple mistakes. The distortion of having rates so low for so long, kind of missing the inflation surge and having to do something that would likely drive us into a recession, and then not being proactive in kind of reducing the rates from the level that they are today.
Professor Campbell Harvey, thanks for coming on the podcast.
Thank you for inviting me.
That was Dr. Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University. What stood out to me about that conversation was how there are still remaining questions about the ways that this cycle is or is not different. Statistical regularities that were helpful through recent decades have been thrown to the wayside during the pandemic, but there's still some time before the jury is completely out on the inverted yield curve. I also thought it was interesting to hear Professor Harvey talk about the possibility of the inverted yield curve being causal this time around, since higher recession expectations from the inversion may have dampened investment and hiring decisions. Fed Chair Jerome Powell will speak at the Kansas City Fed's annual symposium in Jackson Hole this morning, where the topic will be reassessing the effectiveness and transmission of monetary policy. The appearance also gives Powell an opportunity to steer financial markets in a new direction since he last spoke at the July 31st press conference. Because of the relatively narrow divergence between market expectations and Fed communication at this point, Powell could instead just emphasize the Fed's data dependency and approach of making policy decisions meeting by meeting. Next week, the big data focus will be on the July PCE report on Friday. The encouraging CPI and PPI point to another soft reading in the core PCE deflator, while strong retail spending last month suggests a still resilient consumer. The following week, the ISMs for August will help set the market tone, while a couple second-tier reports will give more clues about labor market strength. The July jolts will be out on Wednesday, September 4th, and could show that hiring and quits have gone past the point of normalization and into territory consistent with the labor market downturn. The ADP data on September 5th tend to cause market movements even if the connection to the BLS data has been weak during the pandemic. The main event, however, will be the September 6th release of the August employment report. Fed officials have so far not been swayed by the rapid increase in the unemployment rate over the last 12 months, believing most of the increase in joblessness is from labor force growth and not concerning layoffs. While more months of cooler inflation data are unlikely to increase urgency at the Fed, worries of further labor market deterioration could encourage officials to undergo more rapid easing. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.